So I have Bill Westrom of Truth and Equity with me today, um, and we are going to discuss about how we can take advantage of additional equity in your house to pay down the mortgage much faster. Usually we end up as homeowners or even investors, we end up refinancing the property and taking most of the equity out, but then we restart the clock of 30 years again. Instead, there are some neat strategies, and I've been working personally with Bill to implement this strategy for my whole primary home as well. So welcome, Bill.
Thank you, Alpesh. Appreciate the opportunity.
Thank you so much for joining us today, Bill. Hey, Bill, can you explain us what this is about and how long have you? Okay, let me even backtrack. How long have you been doing this strategy, and why everyone is not aware about this strategy?
Well, I've personally been involved for about 15 years from when I first got introduced to it as a mortgage broker back in 2000, well, actually just 2001. So I guess I'm close to 16 years, 17 years.
Oh, wow, that long.
Yeah. But Truth and Equity has been around since 2006. And I got introduced to this strategy. The Australians brought it to us, Macquarie Bank out of Australia. And I ended up working for them in early 2006. And their business model was to get it to the public via mortgage brokers. Right? They weren't a retail operation, wholesale. And I realized every broker didn't get it like I did. So I decided I was going to bring this to the public myself, and I grabbed a guy that did get it, and we started Equity. But and that's one reason that it's not a mainstream product or strategy out there, is that originally it was brought through brokers. So if you didn't hear about it from a broker, you weren't going to see it on Sunday Night Football.
Oh, I see.
And Macquarie has since gone away after the bubble blew up. But again, it's just not a mainstream thing. If it's not seen on TV and it's not offered by all our trusted advisors, or the B of A's and the Edward Joneses of the world, your major advertisers, it's just an unknown concept. I'm just a little company. I don't have a multi-million-dollar marketing budget that I can spend $500 to $1 million on a 30-second ad. So,
right.
And that's really the reason why it's just not, it hasn't been brought mainstream through the media channels.
I see. So how does this strategy work? What exactly does a homeowner or an investor needs to do to take advantage of this strategy?
Well, before I get to what they need to do, let's just talk about what it is.
Oh, okay? Yeah, sure.
And what we're really talking about is we're talking about a new model of banking and borrowing. Now, that confuses some people because they're not even sure what sort of model they're working under right now. But it's the basics of how we bank and borrow. Income goes into a checking account.
Mm-hmm.
We finance our lives with low rate and low payment loans.
Yeah.
We're saving it, we're paying less interest, we're saving interest, and we're being fiscally responsible. And, we chase our life around out of the checking account. It's more of a spending model than it is anything else.
Exactly.
Because we're not getting any financial benefit out of what we do.
No, yeah. When I put my money in my savings account, the bank pays me less than 0%. I mean, less than 1%, and they turn it around and use my money to loan the same money to me at 4-5%, right? So we are not saving money.
No, you're not. Now, here's the interesting fact. This is where the benefit of the current model goes. Currently, with all of our debt on a national level, homes, mortgages, cars, student loans, credit cards, we're about $9 trillion in debt as a consumer base. And all that debt has interest. And if you take a very conservative interest rate of 5%, then the institutions, the creditors, if you will, they're earning $50 billion a month in interest.
My God.
Off of these financial products that they market as a benefit to us. Right? Now, if you look at our deposits, we deposit approximately 12 to 13 trillion a month. And the banks, from what I've seen, their average rate of return on our deposits is 4%. That's close to another 50 billion a month that they're earning on.
That's amazing.
Deposits. So that's close to 100 billion a month that the current conventional model that we participate in, and it doesn't work if we don't do what we're told.
Right.
They're earning close to $100 billion a month. So that's what the current model of checking accounts and low rate, low payment loans is doing to us. All right. So that's the current model. Now, the new model is to practice the same principles the bank practices to earn that money, right? Or let's say to earn on our deposits, because they take our deposits and they leverage. That's the key word.
Yes. They leverage. Yep.
They leverage our income into some interest-bearing activity, and they keep all the spoils. Okay, so if leverage is the only principle at play, we can do that easily. And we do it every month anyway with our 401ks. We're leveraging a percentage of our income. Down payments for homes, we're leveraging our down payment to secure the property. So we understand the concept. We just don't understand it on the debt side of the ledger, right? And the debt side is probably the most mysterious side of our finances, because most of us don't understand it completely beyond a rate and a payment, right?
Right.
And so that's where I come into play, is help people and educate people to understand how the model works and introduce this new model. Well, the new model, as people will discover, and as you've talked about, involves a home equity line of credit, HELOC. All right.
So that's the model you are working with, right? When you say new model, that's the model we are talking about in this podcast.
Yep, exactly. Now the HELOC is it's not a new tool, but it's going to be a new tool within the new model, right?
I see.
Because the HELOC has a revolving door, right? Revolving line of credit. We can get in and out at our leisure. So with that capability, it gives us the same liquidity and functionality as far as deposits and withdrawals as a checking account. Okay.
Oh, okay.
So that allows us to leverage 100% of our income into the line of credit. And when we leverage it in the line of credit, it's pushing down the balance of the debt in the line of credit, right? So if we had a $20,000 balance in the line of credit and we had $10,000 of income, we push our income in and knock the balance down to 10 grand, because the leveraging acts like a payment against the balance. So once we do this, we're only paying interest on 10 grand versus the 20 grand we'd pay interest on if our 10 grand was sitting in our checking account. Okay. Now we've got 100% of our income into the line of credit, but we'll need 100% of our expenses: lights, groceries, keeping the kids fed, cell phones on their ears. So because the liquidity factor in the revolving door, we can go back in and get what we need without permission, without application. It's ours. So let's say we go in and take $8,000 out to cover all expenses for the month. So we just go in, we get our $8,000, we pay our bills, and we move on to the next month. Okay. So what has happened in that 30-day billing cycle? Well, we saved interest on our 10 grand because we didn't have to pay interest on the 10 grand we leveraged. Pull out the 8 grand for expenses, and there's a $2,000 difference. 10 in income, 8 in expenses. So that reconciled positive cash flow number, the 2,000, is the net payment against the debt for the month. So we started at 20 and we ended at 18. We paid back 2,000. We move on to the next month.
Okay.
So if we've got a $20,000 debt with $2,000 extra per month, we paid the 20 grand back in 10 months. And we've got access to the 20 grand again because it all resides in our line of credit. That's how it works.
I see. So basically, I'm just reusing the HELOC money and taking advantage of revolving credit. Is that correct?
Can you repeat that question for me?
So I'm taking advantage of HELOC, the revolving door credit with HELOC, right?
Yes. Yeah, what you're doing is you're taking advantage of the inherent features of the HELOC, right? It's a revolving line of credit. It's that revolving door that makes the world go round in this thing. because that gives us the ability to apply 100% of our income against the debt without losing control. And conversely, if you had a $10,000 paycheck and you sent it to your first mortgage, they're going to take the money. They're not going to call you and ask you if you made a mistake. They're just going to take the money. They'll take the interest that's owed them, because that's all they have a legal right to. They'll put the interest in their pocket, and they'll apply the rest against the outstanding balance. God, it'd be a great thing if we could do that, but we can't because it's a closed-end loan. There's no revolving door. So when you go back to your mortgage guy for money for gas and groceries, he's going to hand you a cash out or an application for a cash out refinance.
Yes.
It's their money. That's why we can't do it in the current model. That's why we have to have those inherent features of the HELOC, the liquidity, the revolving door and the liquidity, to control everything we put in and everything we take out. It's a hard concept for people to understand, to have that kind of control over their debt and their, and what their income is doing for them. Because it's really putting your income to work. And why shouldn't it work for you?
So do you, I of course, because I have applied this strategy myself, so I understand, but do you have an example or some examples of this strategy? Let's say, I buy a $500,000 house. What exactly do I need to do if I'm buying a property, or, if I'm sitting on a nice equity, right? What are the steps?
Well, to be honest with you, the first step you should have to do is make sure you're working with somebody that's got some expertise in the HELOC business and how to implement and run this strategy. Because understanding how it works is one thing, as you've well discovered. With my help, we got the right HELOC for the job.
Yes.
And you and I spend plenty of time, breaking your budget apart piece by piece and then reconstructing it within the confines of the new strategy. Okay?
I totally agree. Without your help, I wouldn't have known which HELOC to choose exactly, on which date I should be paying my expenses or credit card statements. There is a lot more involved.
Yep. But to get back to your original question, if you're buying a home, right, and you want to implement this strategy, well, it's all going to come down to the numbers as far as, the purchase price, how much you're bringing down, and fitting it within the lending parameters of the banking world. I mean, we all have to follow their rules,
right,
to be able to qualify for the loan, right? And that's a big part of what I do, is being able to identify, what bank we're going to go to based on those parameters and how we're going to structure the financing. Because it's almost like the investment world. One size doesn't fit all.
Nope.
Right? That's why you got financial advisors and planners to help consumers strategize through, navigate the complex world of investment. Well, this is no different. It's just in a different channel, the debt channel and the loan channel. So again, and every bank's a little different. So, but the interesting thing is even if you don't have the equity or capability of getting a HELOC on a piece of property, we can start the program with an unsecured line of credit, because it's the same animal. It's just not secured by real estate. Now, the rate will be a little higher due to it being an unsecured loan, but it's a temporary fix to build the equity needed in the primary home or the investment home to qualify for the HELOC. So once we do get to that point, we'll jettison the unsecured line and we'll move into a HELOC.
I see.
So again, you have to be lendable. That's if there's one phrase to answer your question, we have to be lendable one way or the other.
Right.
To implement the program.
So can you give me an example, or maybe a couple of examples from your past, clients who have implemented this strategy, and how long did it take them to, pay off the mortgage? Just one or two examples.
Okay. Well, I'm going to, since the unsecured line of credit theme is fresh in our brain here, I'll give you a great story on that side of it. Had a couple in Colorado, didn't have the equity to get a HELOC, so we got the PLOC.
Okay.
All they could qualify for was $7,500.
Oh, wow.
The interest rate was 12.75%.
No way.
Yep. And of course, I took a little prodding on my behalf for them to sign on that loan. As I preach all the time, rate doesn't cost us the money, the balance does.
Yeah,
But anyway,
yes.
we implemented the strategy utilizing that 7,500, and within 6 months, right, along with appreciation, we went from a $7,500 unsecured line at 13% to a $30,000 HELOC at 4.75%
Oh, nice.
within 6 months. And so again, we just started using the HELOC. Now they're still a couple of years into the program, so they're a few
Right.
years off, but they're, needless to say, they were rather impressed with how quickly that worked at 13%.
Awesome.
Let me pick another story. Another guy out in the East Coast. He had a pretty decent sized mortgage. I can't remember the exact number, but I had a projected payoff for him of 3 years and 2 months, and he hit it on the month.
Oh.
And then what he did is he quit his job. He sold the home and seller financed it, meaning he kept the note. He wrote the note. He became the bank. And he got a $30,000 down payment, and he's still collecting a check for $1,600 a month off that note that he put on the house that he paid off utilizing our program.
That's an amazing story. Wow.
Yeah. And I don't think we have the time, because I could sit here and
Right.
give you dozens of them.
Right.
But it's an amazing thing. And really it just comes down to applying 100% of your income against a debt balance 24/7 until it's gone. It's an amazing thing.
So let's say, I did this strategy, of course, but let's say I'm someone else. I take the HELOC money and spend it on a nice vacation and a Tesla. Would this still work?
Well, yeah, it sure will work, because you can have that great vacation and go buy the Tesla, right? Now we've added more debt.
Yeah,
Okay?
exactly.
So if we are adding a debt balance to the original balance, mortgage balance, well, obviously that's going to slow things down a little bit, because a debt balance is a debt balance. It's got to be taken care of. But depending on the numbers, $2,000 a month, as we were using earlier, if you took a $10,000 vacation, you've got that thing paid back in how many months? 5 months. And you get to go utilize the 10 grand that you spent on your vacation, because everything you paid back landed in your line of credit. So now we'd start, now we've got a Tesla. I don't know, what's a Tesla cost? 80 grand?
Yeah. 80
Right?
grand, 220, whatever.
Right. Well, at 80,000 at 2,000 a month. Now it's going to take a little while. It's going to take a few years to get that paid off.
Right.
Right. But again, on an $80,000 purchase, I mean, what's a payment on that thing? Right. I don't even know
About,
what
yeah, 1,000 to 1,200.
Yeah, $1,200 a month that you're stuck with for 6 years to pay it off. When you run this program and have it paid off, and you're not stuck with that $1,200 payment, you're only obligated to the interest. If you can have that thing paid off in 4 years, it's a beautiful thing, because you've self-financed it. You become your own self-financier through this line of credit, which means now everything is done on your terms and not theirs, which is a beautiful thing. So again, you pay the Tesla off in 4 years. So your vacation's paid off in 5 months. Your Tesla's paid off in 4 years. We added 4.5 years to the payoff of your current mortgage, because we had to divert funds. But if that moved the dial from an 8-year payoff in your mortgage to 12.5 years for everything, I think you're still a lot better off than 30 years, don't you?
I agree.
Now, here's another great thing, right? Just like you get access to your vacation money. Well, the 80 grand you spent on the Tesla is now available to you. So we're going to use the equity in the Tesla within the line of credit to go pay off your mortgage.
Oh, I did not think of that.
Because it's your line of credit. The line of credit is an endless supply of working capital, as long as you're paying back what you borrow.
I get it. So, don't you have to be a little responsible to apply this strategy and be careful with your money?
Yes. And now a lot of people like to use the word discipline.
Yep.
I hate that word.
That's why I did not use that word. I was going to use that word.
Yeah, it has too much negative connotation to it, right? It's like being disciplined enough to go to the gym. We all fail at that every day.
Yeah.
We all know we should go to the gym and work out and be healthy, but we fail at it every day because it's work and it's no fun. What I like to refer to as fiscal responsibility, right?
Yep.
So if you're a fiscally responsible individual going into the program and you maintain that fiscal responsibility, you'll be fine. Just don't be a fool with your money.
All right. So, who are good candidates to apply this model? Let's say some, existing homeowners. Who would be good candidates?
Good candidates for this program. For one, the fiscally responsible.
Okay.
Number one. If you're fiscally responsible, more than likely you're going to be lendable. Good credit.
Yes. That's
right. Good credit. You meet all the underwriting guidelines. So fiscal responsibility, lendability, but more importantly, want and desire. You got to want to get out of or get off the treadmill. You want to, the conventional model is the treadmill. You really need to understand the problem with it, and you want to get off. And you're willing to make a change to do it.
I agree.
And then, of course, positive cash flow is critical for the acceleration process.
Yeah, so that's where I was going. So your income has to be more than your expenses.
Yes.
And don't you need to have some equity in the property, or you can, if you don't, then you can take advantage of personal line of credit, right?
Yep. You need equity for a HELOC. You need good credit for an unsecured line.
Oh, okay, I see. So basically, you should be fiscal responsible, in turn, right? You got to have good credit, and your expenses should be lower than your income.
Yes.
Got it. Okay.
If I can add to that real quick, because sometimes people will look at their personal budget and say, I'm no good because I have no cash flow. Well, we like to be able to take a look at it because a lot of times people don't have cash flow because they have consumer debt, credit cards, vehicles, student loans, right? Those consumer debts, the payments on those consumer debts and the money needed to service that, cash flow killers, right? That sucks up more cash flow out of somebody's pocket than just about anything. So if we can attack those debts first and take back control of that cash flow, then we can turn somebody that doesn't believe themselves to be a good candidate into a phenomenal candidate.
I see.
But it just comes down to breaking down the numbers and running an analysis to see what the end result would be.
Got it. And do you work with everyone throughout an entire U.S., or are you, focused on certain states?
No, we're border to border, shore to shore. We can work with any homeowner in any state in the country.
Got it. Cool. This is awesome. Is there anything else we forgot to talk about, Bill, or you would like to add?
Well, what I'd like to add, because a lot of people are relying on the internet as their educational resource with this thing. And inherently the internet, it's come to be known as, the teaching you everything you ever need to know. Right? Now, if you want to change the brakes on a 19 or a 2000 Chevy, hey, you'll find lots of videos and they're really good.
Yeah.
How to change brakes. But when it comes to this subject matter, it's all informational. It's not educational to teach you how to do it. It's there to help you understand the concept and be driven to, an expert that can help you through the process. So don't rely on the internet as your teacher, because the internet cannot customize an approach specifically for you, because the internet knows nothing about you, your budget, where you sit in life, where you want to go, college kid tuitions, et cetera, et cetera, et cetera. So don't rely on the internet as your educational resource to put this together. Get some professional help. That's probably one of the most important things I can relay to the public.
I couldn't agree more, especially that I signed up for your program as well.
Well, and as you've experienced, the real key to the success for my customers is the service that I provide beyond helping them get the right HELOC, right? It's the how to do it, how to run life day to day, week to week, feeding the family, paying all the bills, and taking the conventional methods of managing all your expenses and bringing them into this new profile or this new model. And as you've experienced, we have monthly get-togethers, right?
Yes.
Excuse me. You're going to be able to edit this out. I have to clear my throat. But you're sending me your HELOC statement, and we're getting together on the phone, and we're going through your activity, and I'm monitoring your progress and evaluating your performance along the way. That's the claim to our fame, is having that personalized one-on-one service to ensure that you're doing things properly, doing things as instructed, and getting the most out of the program.
I agree.
And that's critical to success. So you're not left to your own devices. And and through some of your referrals, and I got a lot of guys across the country, I love working with investors. I've helped investors double the rate of acquisition compared to what they would have done under the conventional model. And I have a lot of fun strategizing, short and long-term goals for somebody to fill their real estate portfolio. This is a phenomenal program for investors.
And then that's exactly what I'm doing. While I'm trying to pay down my mortgage, I'm also taking advantage of the HELOC. A pretty good amount of HELOC I have, of course, and acquiring properties as well at the same time. So
because really, whoever comes to us, whatever their agenda is my agenda. Whatever you want to do, just tell me what you want to do. Pay off the primary, invest. Maybe we can serve both masters at the same time. But whatever you want to do, I'm just going to help you get there faster than you would without knowing me. And I love what I do. It's a lot of fun.
Exactly. I think you got to enjoy what you do. Otherwise, you wouldn't be able to help everyone, right? So that's the key.
That's the key. You got to have passion. Got to have passion.
So that was great. So Bill, how do people reach out to you?
Well, all they need to do is go to truthinequity.com / right now. We're gonna have to stop here. You're gonna have to edit this out, Alpesh, because I don't have your guest book page address in front of me.
Sure, it should be Wealth Matters.
Okay, is that it?
Yeah.
Okay, then the only thing people need to do is go to truthinequity.com / wealth matters, and that will lead them right to your guest book page, Alpesh, and they just complete their profile, and somebody will contact them to schedule another meeting to go through their numbers and conduct a thorough analysis to see what this thing will do for them, and then our recommendations will be made at that time.
That's perfect. And if anyone of the listener wants to get more information about this from me, then please reach out to me as well via email, alpesh@wealthmatters.com. And I would be able to, give you firsthand idea about what I have been through and how I have been working with Bill on this thing. So we'll wrap it up here. Thank you so much, Bill.
Thank you, Alpesh. It was certainly a pleasure, and I'm hoping we can help a lot of people.
Okay, will do. Thank you.
All right.
Bye.
See you.